In the summer of 1998, a quiet panic gripped the highest halls of global power. Central bankers from Washington to London were making urgent, secretive calls. They were not worried about a country collapsing, no. They were worried about something much smaller, yet vastly more dangerous. They were terrified of a single hedge fund located in Greenwich, Connecticut. Long-term capital management, or simply LTCM. Inside this nondescript building sat the most concentration of financial intellect the world had ever seen. They were Nobel laureates, MIT professors, Wall Street legends. They had created a perfect mathematical formula to predict markets, a money printing machine that simply could not lose. But in a shocking series of events, this group of geniuses lost $4.6 billion in just 4 months. And they didn't just lose their money, they took the entire global financial system with them to the very edge of a complete implosion. Today, we uncover the shocking story of how the smartest men on Earth created a weapon of mass financial destruction. To understand how a hedge fund could threaten the entire world, you first have to understand who these people were. LTCM wasn't just another fund. It was the ultimate dream team. At the helm was John Meriwether, a legendary bond trader at Salomon Brothers, known for his ruthless aggression and uncanny ability to spot profit where others saw nothing. He recruited a team that would make any university jealous. Chief among them were Robert Merton and Myron Scholes. These weren't just finance guys. They were the architects of modern quantitative finance. In 1997, they would be awarded the Nobel Prize in economics for creating the famous Black-Scholes model, a formula that essentially determined how to price options and manage risk perfectly. In their minds, they hadn't just studied the market, they had solved it. They believed they had removed the messy human emotion from investing and replaced it with elegant, unbreakable math. And for the first 4 years, the world believed them too. LTCM's returns were astronomical. 21% profit in 1994, 43% in 1995. Billions flooded into Greenwich from around the globe. Governments, corporations, wealthy families, everyone wanted a piece of this guaranteed genius. The money printing press was running at full speed. But what no one was asking was, how were they doing it? The geniuses at LTCM weren't picking stocks based on feelings. They were doing something called arbitrage. Think of it like this. If you see a gold coin being sold for $1,000 in London, but the exact same coin is selling for $1,001 in New York, you buy it in London and instantly sell it in New York. You make a $1 profit. Sounds simple, but LTCM was doing this on a colossal scale, across thousands of complex, obscure financial instruments. They would look for tiny, temporary mispricings in bond markets around the world, and they would use their superior computer models to bet that these prices would eventually come back into alignment. The problem? These profit margins were tiny, fractions of a cent. To make real money, they needed scale. They needed leverage. Leverage is just a fancy word for borrowing, and boy, did LTCM borrow. For every $1 of their own money, they borrowed up to $30 from Wall Street banks. And because they were Nobel laureates, the banks were happy to lend it to them. Everyone wanted to be in business with the geniuses. So their total investment power wasn't just their $4 billion capital. At its peak, their leveraged position was over $100 billion. And that is not counting the nearly $1 trillion in derivative contracts they were exposed to. A 1% miscalculation wasn't a problem for a normal fund. For LTCM, a 1% mistake could be a catastrophe. But the dream team wasn't worried. They had an unbreakable safety net. a mathematical model called value at risk. It told them the maximum amount of money they could lose in any given 10-day period. The math said that a complete collapse of their fund was a mathematical near impossibility, a 1 in a trillion shot. They were safe. Until they weren't. It happened in August 1998, the single event the LTCM models had deemed impossible. Russia defaulted on its debt. It sent shockwaves through the global system. In a normal market, when a small player fails, it is contained. But Russia defaulting triggered something far worse than a temporary mispricing. It triggered panic. The beautiful mathematical models developed by Merton and Scholes had one fatal flaw, one single human flaw. Their models were built on history. They assumed that markets behave rationally, and that humans, when panicked, also behave rationally. But history had never seen a global liquidity crisis like this. Humans don't behave rationally in a fire. They stomp on each other to get to the exit. Every investor in the world wanted to sell everything and buy only one thing: safe, liquid United States Treasury bonds. Every other market froze. No one wanted to trade. For LTCM, this was a disaster. All of their thousands of unique, perfect bets were predicated on markets returning to normal. But now, markets were behaving completely, chaotically, irrationally. The formulas stopped working. The computers started spitting out terrifying red numbers. In just one day, August 21st, 1998, LTCM lost $553 million. Every time they tried to sell a position to save themselves, there was no one to buy it. They were trapped, crushed by their own massive leverage. Inside the Federal Reserve Building in New York, the realization was setting in. If LTCM collapsed, it wouldn't just be one fund going down. Wall Street had lent them $100 billion. If LTCM failed, those banks wouldn't get their money back. This would trigger a chain reaction of failures that would freeze global credit. The entire world economy would go dark. They were too big to fail, long before that term became common. Central bankers knew they couldn't use taxpayer money to bail out a billionaire hedge fund. That would be political suicide. So, on September 23, 1998, the head of the New York Fed summoned the CEOs of every major Wall Street bank: Goldman Sachs, JP Morgan, Merrill Lynch. He sat them in a room and told them, essentially, you lent them the money. You created this mess. Now, you are going to fix it. He forced a consortium of 14 banks to each chip in hundreds of millions, creating a $3.6 billion private bailout to take control of LTCM and wind it down slowly. Wall Street was saving itself from its own creation. Long-term capital management was dead. The dream team had been crushed, and the Nobel laureates would never be seen as financial gods again. They thought they had solved risk, but their greatest arrogance was thinking they had solved human chaos. The legacy of LTCM is simple. It taught us that math can map the known, but it cannot predict the unknown. Genius doesn't beat chaos. And in the world of finance, the perfect formula does not exist.